Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 28th of 2022. Please see our disclaimer for important information. Well, we've got a lot of charts this week, a lot of interesting stuff in the weekly reading, so bear with me, and we'll get through this as quick as we can. So here we go with some information on gasoline prices. Obviously, everyone sees us as at the pump, but you can see this visually represented here. The gray line on the chart on the left represents the nominal average retail price for regular gasoline. Again, there are obviously different blends, but this is just for regular gasoline. And then you can see in kind of this pink line what that represents in terms of inflation adjusted. And so obviously we've spiked here recently. You can see that, but you can see in both nominal terms and inflation adjusted, we were dealing with higher prices back in this time frame from the end of the global financial crisis, really into the middle of the last decade. On the right-hand side, you can see the gasoline prices adjusted for wages. Again, this is probably it's the same data, really kind of the same chart, but it just gives you a different view, perhaps without all the noise. But this is adjusted for wages, not necessarily inflation per se, but it's kind of a real impact on the average consumer based on their wage pattern. Here is one thing that I've kind of taken note of in looking at all of the inflation data that we've been monitoring lately on energy and everything else. But I've mentioned this in market minutes before, but it's worth repeating here. You can actually see it graphically depicted. So this is the energy spending as a percent of total consumption, and you can see that basically from the 1960s, with the exception of the spike in 80 when we had really high inflation. Obviously 73 we had the OPEC embargo, so energy as a percent of the total basket increased after that. But since the early 80s, I mean, we've really been almost in this secular decline with a little bit of hiccup there around as this was rising, ahead of the global financial crisis, and it stayed high for a few years thereafter. But really, energy as a percent of the total consumption basket has been going down, and so these energy price shocks are less impactful in terms of their impact to the total wallet of the average consumer. Here's a quick look at durable goods, X transportation, capital goods orders, non-defense X aircraft. Both of them had a slight tick, and they were far below expectations of positive gain. You'll see here in a second that it really is almost dependent on where you are in the U.S., because there's a geographical emphasis in terms of certain industries that are actually doing a little bit better than others, but overall we can see that we took a little bit of a step back, if you will, in terms of orders. And of course, the question is, are we slowing down? And so let's take a look at some of these other regions. Here's market manufacturing purchasing managers index, and actually it took a slight uptick. And you see the services PMI also took an uptick. And again, these are diffusion indices, so anything above 50 represents expansion. And as you can see here, much more often than not, we are in expansion, and we have been obviously since the recovery post shutdown here. And but there was some speculation as we were trending down as to whether we might be headed towards a contraction, and certainly that's the fear that was engendered by the data that came up in the durable goods orders that we just looked at. But here we can see manufacturing and services PMI both taking a step up in terms of positive expansionary growth. Here's a Kansas City Fed manufacturing index. Again, we see this spiking up. In fact, the actual number was well ahead of the estimates. You can see expected activity over 6 months on the right-hand side, tracking extremely well. So Obviously, Kansas City, the Federal Reserve region that's encompassed by that Kansas City Fed, is doing well. And we see this in the market data that we just looked at. And that seems to belie, to some degree, durable goods orders. Now, again, this is the actual manufacturing data, the actual, what's being manufactured. The orders represent, kind of this future demand, if you will. And so there is some maybe slight predictive merit in this, in the sense that, we might see orders begin to kind of soften up just a little bit. But the overall data with regard to manufacturing and services, frankly, is still relatively good. Here's Kansas City Fed. Just a quick update on some of the supply chain issues and raw material costs, and the story there honestly hasn't changed very much. Prices paid for raw materials took another leg back up, ostensibly because of the Ukrainian incursion by Russia, and certain materials obviously are in shorter supply. And then supplier delivery times. And this is not necessarily an indictment of the supply chain. It's just supplier delivery times as people are working around some of these Russia type choke points. The delivery times are just expanding just a little bit right now. And kind of to wit on the supply chain issues, you can see here really there's an overlay. You've got the supply chain choke points at the port of LA and Long Beach. At one point there were 80 excuse me 80 ships that were waiting to dock, and then that actually spiked a little bit higher. So now, right now, you have 3 ships that are anchored and 53 ships that are kind of hanging out offshore. But that's obviously down from where it was. So, I mean, you've got, a lot of clearing in the system, if you will. And here's some other information from the Richmond Fed. And this is port guidance. So this is like the port of Baltimore, Charleston, and Virginia. These are all within that Richmond Federal Reserve region. And so you can see here, excuse me, that you've got really the numbers are trending down. So you see less port activity. In fact, they're negative from a really a year-over-year basis. So of course, they were extremely strong last year because we had a lot of orders for manufactured goods, for durable goods, and that number's kind of rolled over, and we're anniversarying some really strong numbers. So this doesn't surprise me in the sense that we're getting a little bit of negative activity right now relative to where we were a year ago, which is exceptionally strong. Now, a quick check-in on labor. Here's the initial jobless claims. Again, the labor market's extremely tight. You see this. The survey was for about 210,000 initial claims, and we actually had 187,000. And on this time series, it goes back to the mid-60s. You can see here very clearly that we're as low as we've been really since the late 60s on terms of initial jobless claims, which is actually pretty profound, considering where we were, not only pre-pandemic, but in the wake of the dislocation from the pandemic. The other thing too, which is really positive, is you see continuing claims, which are kind of the systemically unemployed, if you will. You can see that number in that heavily shaded blue area trending below each of the last 10 years. And so, considering where we were 2 years ago, this is a remarkable statistic. So, as we talk about the labor market, obviously there's shortages of labor because claims are low and more people are getting employed, and we still are struggling with labor force participation, trying to get people back into the workforce. And as a result, here you can see in the Evercore ISI permanent placement index that is really spiked. And so this represents companies that are short on labor that are having to go to placement services and try to find help. A good example of this is our local hospitals that are trying to find nurses, and so they put ads out for employment, and they're not getting as many applicants as they certainly need or want, and so they're having to go to the contracted market to try to fill the gaps in the labor chain. And that's just one example of many, many, many that I could come up with. So, as we talk about Ukraine, obviously there's a couple of things here. We'll look at wheat in a second, but naphtha, which is a refined petroleum that goes into plastics, and you think about everything in our lives that has plastic in it, and just think about where this is going to go. Even, I mean, this is moving higher even before the Ukrainian situation. Of course, it pushed it up a little bit further. Now, I do know that there are a lot of speculators in the market, and we're going to look at the Ukrainian impact on Europe in just a little bit. But here we have kind of something that we need to watch out for because of the preponderance of plastics in all of our daily lives. Whether it be molded fittings within cars to enclosures for electronic devices to a packaging for appliances. I mean, you name it, there's plastics in our daily life. And so we want to make sure that we're monitoring the cost of the inputs that go into making plastics. Here's the quick look at wheat. Obviously, Russia and Ukraine account for over 20% of the global supply of wheat. And so, not too surprisingly, we see this really spiking. But you think about wheat that goes into lots of cereals, and it goes into a lot of different foodstuffs. That obviously the inputs there are going to remain with us for a little bit now. All right. Well, here's an overlay of real oil. And these aren't prices. This is an index. This is an oil index adjusted for inflation, and then it's overlaid with Fed funds. Excuse me. And you can see here, it's a little bit of a busy chart, but there is a positive relationship. And so the story here is that we've had a spike in real oil, and that tends to, coupled with a tightening cycle, tends to presage a recessionary environment, which you can see in those green shaded bars across the landscape as this time series takes us back to about 1970 or so. But yeah, so and again, not to say that past is prologue, but there is a relationship when you have an oil price spike and you have a tightening cycle that tend to be at some point ahead of an inflation, or in some cases you find yourself in it at the same time. Here's a chart I thought was real interesting from Numera Analytics, trying to get their arms around the total growth impact from the impact of taking Russian crude off of the market, as well as Fed rate hikes and geopolitical risk, which is always there. But again, I tend to think less of that as a longer term impact. Here you've got essentially the first quarter of 22 looking all the way out into 2024. And so what you're seeing here is that over time, the Fed rate hikes are going to have the most impact on overall growth. And in this case, they're looking, Fed rate increases of, roughly about 0.7% of impact on growth getting out into the next couple of years. And oil price impacts waning over time, and geopolitical risk, at least by this study, shows to be relatively consistent, over the next couple of years. But again, the big issue, and what we've said, from day one since Russia invaded Ukraine, was the big deal that we need to pay attention to is the rate tightening cycle. That has the most predictive value to us of anything out there right now. Well, and so the best way for the Fed to manage inflation is to find a way to kind of choke off demand. And one way you do that is create a situation where you have tighter financial conditions, and that's where we are now. Yeah, and this is a Goldman Sachs U.S. Financial Conditions Index. And I think it really does a good job of kind of showing how far we've come. Now, we've showed you charts in the past that have kind of reflected the fact that that we've seen so much more short-term rate increases ahead of the first official Federal Reserve rate increase than we have in perhaps the last 4 or 5 different tightening cycles. I mean, we've had a huge move in the two-year Treasury. We've had a pretty strong move in shorter-term interest rates overall ahead of this rate increase. So in some respects, the market has already done part of the Fed's job for it, and that's like increasing these short-term rates and making financial conditions a little bit tighter. So here's a quick chart from Bloomberg on U.S. short-term borrowing costs. And so you can see, really to illustrate my point from the last slide, is that we've seen, at least as far as history goes, it's one of the most dramatic increases in short-term rates on a quarterly basis that we've seen in many, many, many years. I mean, the last time we saw this, we did see this like right after the global financial crisis ended. And then we've seen like bouts of uh, meaningful increases in short-term rates, but we haven't seen an increase in two-year Treasury yields of this magnitude. We've got to go all the way back to like the early 80s for that. So I mentioned this on commodities. This is, an interesting slide, and it's something that I've been spending a lot of time thinking about lately. Is the weightings of commodities within our investment sphere? And here's a quick look by you know different asset subclasses, if you will. So you've got European equity indices, you've got gold, you've got the U.S. S&P 500 and the dollar. And if you look at commodities overall during tightening or hiking cycles, commodities tend to do extremely well. And they've already done fairly well, but this would argue for an increase in allocation to commodities right now. Well, we talk a lot about the yield curve, and I thought it'd be good to kind of show what that looks like right now, actually. And we have really two relatively short-term indicators, and the yield curve moves around a little bit from week to week. Excuse me, and you can see it here. You start off on the left-hand side at really just kind of like short-term yields, like inside of 1 month. And Fed funds is actually literally overnight rates, and you can see those are have moved up in response to the Fed's increase in their target rate of the Fed funds rate to 25 basis points or 0.25%. Now, as you get along the curve, you can see the dramatic increase, and this is what we've been talking about over the last few slides, that the market has priced in a lot of rate increases um, already. And you can see where you get into the two-year yield, and particularly the three-year yield, kind of in that 2.25, almost a 2.5 range. And that's fairly flat. In fact, we actually have three-year rates that are higher than the 10-year rate. And then, there's a lot of demand, especially when you get into, geopolitical risk, a fair amount of demand for a safe haven type asset. And so we've had a lot of demand for U.S. Treasuries, particularly at the 10, 20, and 30-year maturities. And you can see why that's pretty flat right there. So very steep curve up till you get about 2.5 years, and then it really flattens out quite a bit. And you can see, the dramatic increases in those rates in literally just the last week. Well, and here is kind of a different representation of what you just saw. So the spread, which is, and we've got two iterations of this on the left-hand side. You've got the 30-year Treasury minus the yield on the 5-year Treasury. And as we just saw on that last slide, it's pretty flat, and it's gotten a lot flatter really over the last year. And you can see that here that, at one point it was about 1.6% different, and now it's about 0.1% different. If you go to even the 30-year Treasury minus the 10-year Treasury, that's about 0.15%. So again, both the yield curve kind of at that after that 2.5 to 3 year time frame has really flattened out, and it depends on your perspective. Now, one perspective is that the bond market, which generally does a reasonable job of anticipating changes in economic and market cycles, is anticipating a growth slowdown. I don't think that's any surprise to anybody. I think that's clearly in the offing. You can't have inflation like we've had without some slowing of growth. Now, if it inverts, there tends to be a relationship between yield curve inversion, where long-term rates are actually less than shorter-term rates. That doesn't mean that a recession is imminent, but there is a positive relationship there, and but clearly this is something that is worth considering. Now, the flip side is that I think the bulls would say that the market is yet to really factor in kind of this long-term growth. That we have a lot of noise right now. We've got a Fed that's tightening. We've got a geopolitical issue that's inflating prices. And obviously we've got a lot of outsized inflation, which is not apt to fully continue going forward. But on the right-hand side here, again, just another depiction of what's going on with 2-year rates. We've had a really dramatic increase, and so when you think about these yield spreads and the flattening of the curve when you get past 2.5 to 3 years, you can see that the move that we have had in 2-year rates is pretty dramatic relative to history. Again, it's worth underscoring that because it's moved much more so than it ever has prior to tightening cycles before. And I think it's important to consider that financial conditions are tightening now, and it's accomplishing a lot of what the Fed is wanting to do. And so it takes some of the pressure off the Fed to rapidly raise interest rates. And when we talk about inflation, this is a 5-year break even. So it's taking the 5-year Treasury and it's subtracting out inflation, or it's the difference between the Treasury inflation protected security and the 5-year Treasury. And the difference in yields there is now, as you can see here, about 3.7% right now. And that's moved a little bit higher, and it has really since we exited the shutdown phase, with the market kind of anticipating increased inflation coming out of it. Well, here's the 10-year Treasury yield, kind of continuing on this theme, overlaid against the Institute for Supply Management Manufacturing Index. And we just saw where the market index, which is just another index for manufacturing, the market and the ISM really tell us a lot of the same things. So you can see the ISM number here. Again, the index is a diffusion index, so everything above 50 represents expansion. You can see here that we're about 58 or so right now, and you can see the 10-year Treasury yield. When you go back before the shutdown, go back to pre-pandemic days, you can see that there's actually a pretty decent relationship here between the 10-year Treasury yield and the ISM manufacturing index. Well, that's obviously blown out because during the pandemic, the Federal Reserve took rates to zero, and the 10-year rates became very, very compressed. at the same time that we started having really strong growth in manufacturing because durable goods orders were really spiking in the wake of the shutdown. When people couldn't get out and go to restaurants and movies, they ordered a bunch of durable goods on Amazon and had them shipped to their home. Well, it could be argued then that what we're doing now in terms of the 10-year yield is just simply catching up to where that growth was and over the last couple of years. So I saw this and thought it was really interesting. We've been talking a lot about globalization and trends in globalization, and I think it's fair to argue that really over the last several decades, we've had a real spike in globalization. We've had trade pacts, we've diversified our supply chain. I think you could argue that it added to productivity, which helped keep inflation low. But you can see here that we've had various fits and starts in globalization, and I think it's safe to argue now that we've seen an interim peak in globalization. But the last time we saw a real hard peak like this, a couple of times, but obviously we saw, back in, before the Depression, Great Depression, we saw a peak in globalization as people got more, country specific and internalized and nationalized a lot of production. And then we had a gradual increase, and then we had, in the 1970s and early 80s, we had another interim peak, and then again, just looking at this chart, it's easy to tell that once you get past, really the mid to late 80s, you had this tremendous spike in globalization. So I guess the read through on this is that if we're entering a phase of decreased globalization, that maybe the productivity number goes down, which has helped to keep a lid on inflation, which in turn would argue that our level of inflation going forward is apt to be a little higher than it was, which is exactly what we have been anticipating. Now, some comments about Europe. Clearly the Ukrainian situation is a headwind for Europe right now. We've got Eurozone consumer confidence really flagging right here. You can see German profit expectations for automotive and retail consumer goods, both trending down here in the wake of the Russia incursion. Here is real wages, looking at several European areas. You've got Germany, Italy, Spain, Austria, and the Netherlands, and all these charts look very similar, that you've got real wages that are moving down, which it means that with higher inflation, the purchasing power of the euro isn't going nearly as far as it used to. It's a little bit of a busy chart here, but it was in the daily shot, and I thought it was really interesting. I just point your attention down to the bottom. So you've got crude, oil, solid fuel, and natural gas, and you can see in each case the influence of Russia on these critical energy components and the degree to which Europe is dependent on Russian energy supplies. You can see here on crude imports to the EU, Russia accounts for about 27%. On solid fuel, Russia's about 47%. And then also about 41% on natural gas. So the displacement factor of taking Russia energy out of the European market is quite disruptive. And so it's no surprise then why consumer confidence numbers are really having some difficulty, and we see real wages dropping in the wake of higher energy inflation. In Europe, you do have a higher influence of energy cost as a percent of the total average consumption level. So obviously this is something that we're going to have to monitor, but I thought it was a very illustrative chart here. So here's a quick chart on really on energy and specifically on the interest level of domestic drillers to want to open up more taps for oil. Obviously oil prices are high, and I think there was an initial thought that with higher prices and an embargo of Russian crude that you're going to see an immediate and kind of visceral inflection point in domestic drilling, and you haven't really seen that yet. I do think the capital spending spike is coming as domestic producers begin to reopen drill or well holes that have been capped when prices were much lower. But what you can see here, and we've talked about this before, is that there on the left-hand side, you see investor pressure to maintain capital discipline is really spiked. ESG, lack of access to financing, government regulations, they're all kind of important on the margin, but the real big driver behind the fact that we haven't seen this immediate and kind of like almost patriotic response by domestic drillers is that there's much more of an emphasis now than there was in previous energy price cycles on capital and investor discipline. And here's another illustration of kind of that fiscal discipline and what the energy sector looks like right now. This is the S&P 500 energy sector free cash flow numbers, and not too surprising, with energy prices regaining their strength from the 2020 shutdown, that free cash flow has moved higher. And this is why I honestly think that at some point you'll begin to see a supply response by domestic drillers, that free cash flow now is at such a point overall that it's just simply too attractive for those folks, even though they may want to maintain fiscal discipline. It's just too attractive for them to not be in the game right now. So we start to get into the stock markets here, and here's the 10-year Treasury yield kind of overlaid against the broader market over the technology stocks, and at a time where you would expect small caps to begin to outperform large tech stocks. It just hasn't happened yet. IWM is actually for the Russell Small Cap Index over the technology stocks. So when I say broader market, I meant broader in the sense of smaller caps. But right now we have actually seen a fairly strong response here from large cap tech stocks that is really kind of unusual at this point. And I do think that there will be a point where small caps begin to regain their footing, relatively speaking. Here's a chart that shows us existing home sales over the mortgage rate, and the mortgage rate is in the orange, and obviously we're moving higher with rates moving higher, and I don't think we're going to go back and retest those prior lows anytime soon. We're really up at about 4.2. In some cases, we're already back up to like 4.75, depending on where you are. And you can see here existing home sales in response to higher rates and affordability. You've seen a drop in refi amount. You've seen a little bit of drop in unit volume of sales, even though builder optimism has struggled a little bit because I think of sourcing and things like that, and also the outlook for people being able to afford homes and whatnot. But this is an interesting relationship that we've got. That we have a spike in 30-year, basically 30-year rates, and then existing home sales. And here's a look at the PE ratio of the NASDAQ composite less the S&P 500. So this is the difference. We know that the NASDAQ has traded at, really for the last couple of years, about a 10 multiple point difference. Now we see with some of the changes in volatility here over the last month or so that that's actually dropped, even though it's still well above where we saw it during the decade of the 2010 2010s, it nevertheless has come down a little bit, meaning that we've got the NASDAQ composite a little bit more aptly valued relative to the S&P 500. This is a interesting chart from Gina Martin Adams, and she's a technical analyst, and I don't do a tremendous amount of technical analysis, but this is actually pretty interesting. So last week we had essentially the S&P 500 crossed the 200-day moving average, and so she went back and looked at all the times where that had happened, where the 50-day moved below the 200-day, and obviously we've had some good days in the market, so that's kind of really kind of corrected itself. And this is I guess really from about a week ago, but and each of the last 6 times that happened, stocks over the next 3 months were up on average by about 8.5%. So again, a technical indicator, it has some predictive value. I know that there's a lot of concerns over yield curve and slowing growth and whatnot, but this is just one of those things that tells us that when we have these market corrections, that there's usually, at least for a period of time, there's a kind of a clawback, if you will, and markets are higher after those corrections. Well, here's a chart of kind of a cyclical chart here. We look at the S&P 500 on the upper side. Again, that's not, that's a chart that we're very familiar with. And on on the lower part of this chart, you have kind of these imputed 5 to 8 year cycles. Excuse me. And you can see, in a time series that goes back to 2000, where we are in terms of the 2 to 10 year note spread. Again, this is an indicator of a flattening yield curve. And so, excuse me, when you have a flattening yield curve, as you did, obviously back in 2000, but then you also did, prior to the global financial crisis, and you did back in, really right before the pandemic, we were kind of paying attention to a flattening yield curve. And then here very quickly, we've kind of reattained that level. So, and you look at these 5 to 8 year cycles, and you can see where an inversion led to some softness in the S&P 500. So, I think this time, I'm not going to say this time is different, but this time we have some unique factors that have played into this a little bit more than we've seen traditionally. But obviously there is. We've already seen the response in the tightening yield curves in the market volatility that we've witnessed over the last month or so. And a chart here on the cycles. Here we're entering, frankly, year 3 of the bull market. When you assume that the last bull market started officially in March of 2020, at the end of March, we're obviously 2 years into that. And if you look at these prior bull market cycles, a lot of, there's a lot of data here. I mean, going back to June of 49 through the August of 56 bull market, but you can see where we are relative to that. And so even with our modest, with our correction that we've seen, increased volatility, we can definitely see that we have increased the market has expanded at a faster pace than is typical over the first 2 years of a bull market cycle. Excuse me. Well, and here we go. We've got S&P 500 earnings growth estimates. We've got 2 charts here. You can still see S&P 500 estimates are up about 10%, 9 to 10%. We've actually seen, as we've gone through the first few months of the year, that earnings estimates have actually increased. And so this should give you a little bit of comfort heading into the end of the year. And in particular, we see a benefit from energy as well as tech. Excuse me. And energy and tech have both had fairly dramatic increases in estimates literally over the last couple of months. Well, that's all the charts that I have this week. Probably a little bit of expanded chart pack, but hope you've enjoyed it and hope you have a wonderful week. And we look forward to talking to you again soon. Take care. Bye bye.